Hello, and welcome to the Cavness HR podcast. I'm your host, Jason Cavness. Our guest today is John Richards. John, are you ready to be great today?
Sure, I am very much.
Johnny Richards is an entrepreneur, venture investor, mentor, and educator. His endeavors involve founding, operating, managing, selling, and investing in enterprises. Though he's a generalist, he mentors entrepreneurs frequently in software, internet, mobile, blockchain, and consumer products. He founded a startup ignition and entrepreneur bootcamp. He served as Google Fiber's head of operations as it launched in Provo, Utah. He spent over a decade teaching entrepreneurship at Brigham Young University in Provo, Utah, where he helped it achieve a #2 ranking and bring the Rollins Center for Entrepreneurship and Technology to global prominence. He is listed as one of the top 25 entrepreneurial educators in the United States. He was managing partner of Utah Angels, a venture investing group. He co-founded Boom Startup, a leading tech city accelerator. He has invested in hundreds of ventures and mentored thousands. Early in his career, he was president of a Yellow Pages publishing company and later created the first ever online Yellow Pages that led to an initial public offering and a multi-billion-dollar valuation as part of InfoSpace Inc. John is also a frequent speaker at conferences and other events. He and his family reside in Utah. John, you're doing a lot of great stuff for the entrepreneur community. Thank you very much for that.
Thanks.
So, John, talk about Startup Ignition real fast. How did they get started, and why are you doing that?
Well, Startup Ignition is a boot camp based on kind of the modern day short-term intensive boot camp model. It started about a decade ago with dev boot camps, where it turned out that a 12-week course in how to become a software engineer, a software coder, and you could outperform often 4-year degrees in computer science in terms of actually being able to produce product for the industry. So when I completed my time at Google, which actually had forced me to leave the university environment, I came back, and instead of going back to university, looked at the bootcamp model, and it turned out that entrepreneurship is also a learned skill behavior. And so it was really ripe for a boot camp. And there were only about 5 trying to do something similar across the country, but mostly focus on an entrepreneurial mindset. And Startup Ignition instead is a really practical, hands-on, been there, done it. Here's the steps you need to take in order to launch a company type of boot camp, and found out there was a market for it. And so did that about 3-4 years ago, and hundreds have been through the program now.
Are there a certain type of startups you take on? Is it like business to consumer, any certain niche, or all, as long as it's tech startup?
Any type of startup. It doesn't have to be tech even, but about 50% tend to be software based, and about 30%, tangible physical consumer product base, and about 15-20% across a smattering of other types of businesses. So it's very dominated by today's, more scalable venture niches like software-driven companies and consumer products.
John, do they need a certain amount of traction to come to you to apply?
No. It's from idea stage all the way to companies that have had almost up to $1 million in revenue that were a little stagnated, have come in to kind of make sure they're practicing good lean startup practices so they can prepare themselves for scaling.
The companies that finish the course, what do they get out of it?
Well, it's not an accredited program. There's not a certificate, but what happens is they get a lot of incredible knowledge, mentoring, and connections to network that really help them get things done. So it's more about achievement. So the absolute of our first set of curriculum, the absolute pinnacle is to have nailed a business model. So the program starts off with 3 intensive days of in-class training and then 3 months of unlimited mentoring. And within 3 to 5 months, so maybe a little bit more than the 12-week time frame, the goal is to have nailed a business model. And in today's world, when we say nailed a business model, that means you've absolutely, in a scientific way, have found product market fit. It's not a whimsical guessing game. It's actually mathematically proven that you found product market fit. And that's a special thing, because once you've done that, as long as you set up the infrastructure right, you can have a really fine, scalable business.
Can a company outside of Utah apply to come and attend?
Yeah. We've had people from outside the country come. It surprised me the first time when we had international participants, but we have people from different states around the country, and even international folks come into Utah for the 3-day kickoff, and then we use virtual techniques in order to do the mentoring.
Yes. And you have a pretty good mentoring team too there, don't you? I saw it on your LinkedIn page.
Yeah.
It's you and some other people, some really high visibility people.
Yeah, some really sophisticated educators, and then folks that have literally built companies and exited at very high valuations also have had a lot of failure. So you can't just be a one-hit wonder and teach other entrepreneurs. You have to have had kind of a rounded experience of both success and failure.
So John, speaking of mentoring people, is there a way you can tell that someone does not want to be mentored? Of course, they'll say, "Hey, they don't want to be mentored," and they want to take the block. But you can tell by their actions or words that you're kind of wasting your time trying to mentor this person.
Yeah, we have an admissions process. So they take an entrepreneurial quotient test, which is an assessment of their teachability and also their tolerance for risk and other aspects that are important to entrepreneurship. And then they do an interview with me personally, each person that's applying, so that I can see if they're a good fit. There's definitely some people that should not be entrepreneurs, and there's definitely some people that are not teachable. And those are the two things we're looking for, because we don't want to waste their time or our time.
And what's your average class size, the cohort?
We cap it at 20 each. Every 3 months, we hold a new class of 20 entrepreneurs.
So John, next, in Star Wars, they say, keep on grinding, keep on hustling, don't give up, keep on going, sex around the corner. But when should I finally say, you know what, maybe this isn't for me. Maybe the time's not right. Maybe this idea is not right. When should a founder, go that route?
Well, that's a really good question. So let me just recommend to your readers too, the number one Bible for lean startup, which is again about a decade old or a little bit more than that now, that's swept the globe, is the concept that a large corporation and an entrepreneurial organization are very different. And so there's actually different things we need to do in a startup than we do in just a miniaturized version of a large corporation. And one of those is practicing lean startup when we launch new ideas and new products and new services. And before we launch, we actually test our hypothesis for a business model around that idea. And that testing of a hypothesis involves experiments that can be interviewing with customers, your target customer that you're hypothesizing. It can be doing rapid assumption tests of products, or even building a minimum viable product. But one of the most important things is the concept of interviewing the target customers. And if you're interviewing target customers and you're finding out that you have very, very low potential for product market fit, it's not worth it to hit your head against the wall. And so you either pivot greatly or abandon that idea and go to a new one. And so what's really important, and why there's so much angst out in the entrepreneurial world, is that actually people are launching scalable activity before they have anything ready to scale. And that's when you have all these problems. People should throw in the towel of squandering time and money if they haven't validated a business model, that's for sure. And they should go back and try to validate the business model, which again is synonymous with finding product market fit. If you found product market fit and it's not working, then there's something else wrong, and that then comes down to an execution issue.
John, you got a good point. I think too many entrepreneurs, like, they'll say, I validated my idea. Well, who do you talk to? Oh, my mom, my dad, my 10 best friends, drinking buddies. Like, no, talk to people that have no idea what you're talking about, right?
Yeah. So I was saying one of the books in the industry that teaches this lean startup is called The Startup Owner's Manual by Steve Blank and Bob Dorff, an excellent book. There's another one of the, and I can't remember the author's name right now, but it's called The Mom Test. In the last 5 years, probably one of the two most important entrepreneurship books published, and it's called The Mom Test. And it is absolutely about that very problem, that entrepreneurs are looking constantly for confirmation bias, and they don't go ask arm's length target customers. They're asking their circle of friends and the people that they know how good their idea is.
Yes. John, next, from your experience, talk about some characteristics of successful founders and then characteristics of unsuccessful founders.
Well, successful founders do a lot of things, and that is, again, they focus on making sure that they have devised a solution to a problem that their target customers have, so that they can actually use the product or service. They also after finding this business models I've talked about, one of the most important things they do next, and this is relevant, I think, to you, and that is they build teams. And building a team is a very important process of entrepreneurship. Once the founders of a venture validate that they've got something real, that they found product market fit, now they have to start building a team of non-founders to carry out and execute the business model. This is one of the most important things that entrepreneurs fail at. For instance, you'll find an entrepreneur constantly complaining that they hire salespeople and they can't sell. Most of the time, it's because the founder did not do a good job of devising a system where a non-founder can sell. Because the founder goes out and says, "Oh, I can sell. Let me go show you." And the founder goes out and he lands a couple of customers, and comes back and tells the lazy, quote unquote, salesman that he's not doing it right, not worth anything. And the reality is, the founder needs to find a system that the non-founder can come in and repeat and sell at. That's the duty of a founder. Same thing with all the processes, customer service, for instance, or activation and onboarding. The team that activates and onboards customers is very important to a company. What's their first experience with your product? And the founder has to devise the system to teach to a non-founder how to do these things. This is when you're transitioning from a startup to a real company, building a team of non-founders that can actually execute the systems and infrastructure of a company is a critical component to entrepreneurship. And that's where we see a lot of failure, to be honest with you. That's when you see stagnation and great ideas not take off.
And I think as an investor, you want to invest in if you have two choices, one with two co-founders with no team, great idea, a little bit of traction, or you want to invest in the co-founders with a team of 6 people who are working for free and equity, so to speak, and, really grinding. You think, I would think you want to invest in one of the team, right?
Yeah, you want a rounded team that is that is going to be able to execute. You can't, first of all, one of the cardinal rules of startup entrepreneurship is no lone wolf entrepreneurs for scalable ventures. So you can't just do it as a single founder. You need actually 2 or 3 founders. And then the next question is, okay, the next layer of key people that you bring into the company are going to be employees. They're going to be non-founders, and you want to see that team built. It's a very, very challenging thing in today's robust economy. I'm here in the state of Utah. Utah is, I think, got the #1 economy of all 50 states. We're booming here, and the talent wars are real here. Finding the talent to fill these positions at companies is a real challenge. Matter of fact, what's separating right now the entrepreneurs that take off and the ones that don't take off is their ability to actually attract and train and put in place good employees.
So what would your advice to be on people trying to build a team? Like I tell people all the time, I have my own startup. I can tell, employee number one, hey, employee number one, I'm going to give you 5% equity in the company.
Yeah.
But realistically, that's the same as me telling you, hey, see the pot of gold in the rainbow, I'm going to give it to you, right? It's
Right.
probably not going to happen. So I think it has to be a balance between like being like the visionary, we're going to take over the world versus, hey, this is probably going to fail. So
Yeah.
what advice do you have on people for doing that?
Well, I have to tell a lot of entrepreneurs, they have to remember that some employees have tried the startup route before and had a really bad experience. And so they're going to be really gun shy. And so those are going to be the people that are going to want to see more salary than equity. So one of the currencies that a startup entrepreneur has in order to attract talent is the currency of stock options or equity stock option grants. And they have to be used very wisely and with the right person. If you're trying to attract somebody that's going to require a market rate salary, you're going to have to go out and raise capital in order for you to be able to afford to pay market rate salaries to early employees. But if you can somehow bring the salaries down by offering equity options, which can be a very win-win situation for everyone, for the right person, the right situation, then you have to master how to do that. But obviously, you can only do large equity grants at the very beginning with a handful of key people at the beginning, because you can't give away all of the equity in the company to all the employees. So there's a transition. You're going to go from playing with those 2 levers, how much salary, how much equity, to eventually just moving to market rate salaries for most people. And that also is a real skill set that an entrepreneur needs to have in today's environment. And that, again, is one of the failure points for entrepreneurs. So they have to be very good at negotiating with potential employees in these packages for compensation. If they don't maneuver that minefield well, they're going to step on a landmine. And a landmine in that realm would be, they invest 6 months in a person and the person doesn't stay. And then all of that knowledge leaves the company. Or they know they found the perfect software engineer, the perfect first account executive, whatever it may be, and they can't land them because they haven't planned well how they're going to use the combination of salary and equity to attract the team. Does that make sense?
It makes a lot of sense. I mean, because the pie is 100% regardless, right? It doesn't
Right,
get any
right.
bigger. It's 100%
Right.
is 100%.
Exactly.
And also you got to figure, if you get funding, they're going to want, if you use like 20, 25, maybe as high as 30% equity in a company from the VC side too, right?
Right, exactly. Another really interesting point. One of the things that entrepreneurs and actually Steve Blank, he's the grandfather of Lean Startup, the author of that book I told you about. He has a very famous story that he tells, and I've seen it so many times in my own career. As entrepreneurs, we're often saying, "Oh, wow! If I just landed that person from IBM or Hewlett Packard or Oracle or whatever large company, they're going to make my startup just boom." And it's really interesting. Large corporate executives and middle managers often have a very hard time transitioning to the startup environment. And so all these things have a time and season. And you're going to notice a lot of times that when you recruit that big company person to your 8-person startup, they come in and cause more havoc and wreak more problems because they're just not used to this environment. They're looking for support staff and a much larger marketing budget, whatever it may be, that a startup doesn't have, and the startup's just not ready for them yet. And so it's really important that startup founders and those executives know when the right time is for that kind of ability to bring in those type of people into a growing venture. Too early and you'll have some problems.
John, when would you recommend a founder reach out to? Suppose a founder's out there, they did the research, and there's like 3 or 4 investors they want to reach out to potentially invest. When would you advise them to reach out to those investors?
The optimal time, because you can reach out obviously anytime, sometimes even out of desperation more than inspiration, but the optimal time to reach out to an investor, a professional venture investor, somebody that invests in growing up and coming ventures, is when you can put together 6 months of track record of revenue, customer acquisition or user acquisition, where for 6 months in a row, the month over month growth is 10% or greater. So for instance, whether that be revenue, customer count, or user count, you can show 6 months in a row that each month was 10% higher than the previous month. When you show that, the venture investor does not have to do as much due diligence and knows that you've figured a lot of things out, that they don't need to do a massive amount of due diligence because you're proving it by those traction numbers. The other caveat to that is they're also going to be looking at churn numbers, because you can have high growth numbers with high churn in the early stages, and that the high growth can mask the churn problem. But eventually, if your churn is too high, all of those numbers, revenue, customer counts, user counts, will eventually plateau instead of hockey stick. So you've got to be careful with churn as well. But if I were a startup company and I was in my 4th month of consecutive 10% month over month growth in any one of those numbers, and I knew my 5th and 6th month were going to be that way, I would start engaging with investors and showing them those numbers. And you'll find that the conversation will be very positive when otherwise it's much more of a struggle.
It's like nowadays, most investors, it's pretty easy to find out what they invest in, right? Like you'll go to investors page and they'll say, I invest only in healthcare, only invest in A round. So it's pretty much easy for founder nowadays to go to different venture capital firms and pinpoint that, right?
Well, there's a lot of thematic investors like that, there's no doubt, but there's also generalists. The real big change is mostly between full large venture firms and small seed funds. In the last decade, since the great crash in 2008, one of the biggest changes, and anyone not in the game recently should be aware of this, that the real power brokers in the venture world now are actually the seed funds. They're about $40 to $60 million seed funds, when in the past we used to see 200 million plus venture funds. The $40 to $60 million seed funds in each of the metro markets, they actually are the ones that bless a deal to be anointed or not. And so, because they come in and give the first few $100,000 up to $1 million, maybe max 1.5 million, which is too small of money for a big full venture fund to be messing around with, because it's just as much work for a $500 million venture fund to deploy 10 million as it is 1 million. So they don't want to mess around with 500,000 or a million. So these venture funds, though, they actually come in and do the $300,000, $500,000 investments and send the venture along their way. So that's the real big change, not the thematic changes of investors. That's kind of easy to figure out and find. It's really understanding that the seed funds are who you really have to be looking out for as an entrepreneur in today's world.
John, in general, how much time should a founder allocate for fundraising?
Well, that's a very good question. And you ask any CEO who just completed a fundraising, they look back at the last, 4 months to 12 months, and they'll say, that was like having a second job. It took 90% of my time to raise that capital. And this is why you also don't want to raise capital too early, because you'll spend all your time raising capital, not getting any traction. So the ideal time is when you've got a team. You've been a good manager of bringing on team, and you can delegate to these team members to carry on important functions in the company while you go chase the investors. If you are trying to be everything operational in your company and having to raise the capital, you're going to stall, because it's going to be a very hard endeavor to carry on both of those tasks. That's the reality. It's, if you ask any CEO who just recently closed, let's say in the month of November, how was the previous 6 months for you? And they'll go, it was a nightmare. I spent 90% of my time raising money and didn't get to do what I got. I started this business to make widgets. I started this business to be the greatest widget maker, but I'm actually just a money raiser, and it's just an interesting thing.
John, can you talk about your time as an advisory board member at South by Southwest?
Yeah. So South by Southwest was expanding to Las Vegas, and they did for about 4 years a version of South by Southwest in Las Vegas called V2V. And I really liked it because it was closer to me where I'm at. But I've been to South by Southwest and spoken there several times and put on some highly rated presentations. But during that period when they were expanding to Vegas, I served on the advisory board that helped get that going, especially their entrepreneurship track and their entrepreneurship competition that they had at the Vegas venue. And it was I really liked it and thought it was good, but they didn't continue it after about 4 years and just went back to centralizing everything in Austin. But it was held at the Cosmopolitan Hotel, I believe, most of the time. And I thought for what it was good.
John, I understand you have a gift for our listeners.
Oh, yes. So Startup Ignition is a in-person live boot camp that's held in Lehi, Utah. Lehi is the city in between Salt Lake City and Provo. It's a booming tech center now. We just had an $8 billion exit for a company. Some of the biggest, most important tech companies in the country now are in Lehi. And so we hold a boot camp there about every 3 months. The tuition's $1,999 or $2,000. And for any listener today that mentions that they saw this podcast, if they want to attend and come in and stay in a nice low-cost hotel for 3 days and be a part of this 3-day boot camp, we'll give a $500 discount. So $500 down to $1,500.
So, John, I think in Utah it's called Silicon Slopes, is what they call it.
Yeah. Silicon Slopes is the name that we've adopted, just like, up in Oregon, they call themselves Silicon Forest. In New York is Silicon Alley. And so we're the Silicon Slopes, because when you arrive at the Salt Lake Airport, within 20 minutes, there's something like 13 major ski resorts. So.
John, can you share your social media links so people can reach out to you?
Sure. I'm on LinkedIn. Very easy to find. Just John Richards in Utah. Super easy on LinkedIn. At Twitter, I'm John Richards _UT for Utah, and then and that's JOHN, the John, and that's the best way to reach me. And I also invite you to email. I'm fine giving out my email, jrichards@startupignition.com, and I'll take any question from any entrepreneur that they want to ask, and I enjoy doing that.
And for listeners, we have the links to his social media and his resources at our blog, and our blog is at www.cavnesshrblog.com. John, we're coming to the end of our talk. Can you give our listeners any advice or wisdom, or anything you want to talk about?
Yeah, just in today's market, one of the most important things that you can do for yourself is to make sure that you are taking the time to understand what you're getting into as you think about launching a company or think about taking an idea to market. And just like you need to be very careful when you're hiring people, and you're being very careful, the old saying on hiring is an ounce of prevention is worth a pound of cure. So be slow to hire, quick to fire. Same thing with your customers. The message today is the same thing carries on. You need to make sure you understand your customers very well before you press on the accelerator and put too much gas in the tank.
Thank you, John. Thank you, John, for your time today. Really appreciate it.
Thank you. It was a pleasure.
And to our listeners, thank you for your time as well, and remember to be great every day.